Stock market is filled with individuals who know the price of everything, but the value of nothing. A quote from one of Wall Street's most famous investors, Philip Fisher. Now, what I took out of this quote was that going into the stock market without a strategy is ultimately doomed for failure. And looking at past market prices or listening to people on social media tell you which stocks to buy is not a strategy. So then, what strategy is best for investing? Well, a strategy I'm currently implementing is a strategy by arguably one of the greatest investors of all time, Bejamin Graham, who also taught this strategy to the likes of Warren Buffett. Now, this is a strategy known as value investing, basically where you calculate a stock to be undervalued based off some sort of fundamental analysis. So in today's video, I'll be explaining how you can implement value investing into your strategy based on 3 key ideas that are fundamental to being a successful value investor. First, let's look at speculative buying versus actual investing. Now, if you were to think about how you actually bought your stocks in the past, if it sounds something like this, where you looked at the past price movements of say the past 5 to 10 years, or heard on a YouTube video someone saying this is a great stock to buy right now, this would make you a speculative buyer and not an investor. And here is why. So if you've looked at price movements as a baseline for buying your stocks, I ask you one simple question. Just because a stock has continued to increase in price over the last 5 years, why should it continue to increase in price over the next 5 years? For example, if we were to look at a big company called WorldCom in the 1990s, they had a starting share price of $0 at 1985, which increased all the way to $60 a share by 1999. But by 2002, they ended up filing for bankruptcy. So therefore, just because a stock's prices continue to increase over the past is not a good argument for an investor to say a stock's price will continue to increase in the future. Now, when it comes to investing, and especially value investing, there must be some sort of thorough analysis of the business before you even consider buying it. For example, if a friend pointed across the road to a business over there and said you should buy it, would you consider buying this business without knowing what the business actually does or doing any analysis of how the business is actually performing?
Hell no!
Well, that's what I hope your answer would be. But with stocks, we buy them all the time without even knowing what the business actually does or if it's even performing. Now, whenever we hear someone on social media or someone from Wall Street say buy the stock, we blindly follow their advice and buy the stock without any thorough analysis of what the business actually does and how it's actually performing. And the same thing happens when they tell us to sell the stock. Because at the end of the day, these platforms we trade on, they want us to be a speculative buyer and seller. Because the more you buy and sell, the more money they make in transaction fees, even if you're losing money. And to just sum all this up really quickly, a business that is usually performing really well, long term will usually have a good stock price return, and a business that is often performing really badly, long term will often be reflected in bad stock price performances. So if you can learn to analyze a business to see if they're a good and strong business, this is a really good step to move away from being a speculative buyer and towards being a value investor. Now, the next thing that must be considered to be a good value investor is to have a diversified portfolio. This is because as a value investor, you want to reduce the amount of risk that you can make a loss while also maximizing your returns. Now, when I hear many people talking about having a diversified portfolio, I hear many people just saying don't put all your eggs in one basket. Now, although this saying is right, it could be better. Now, let's say you didn't invest all your money into one stock, but invested your money into, say, Apple, Microsoft, Amazon, Meta, and Google. Can you see the massive problem with this? Now, the issue of investing all your money into just those 5 stocks is because those stocks are all part of the technology industry, which means basically you have zero diversification, because basically if the technology industry is doing really well, you're going to do really well, but if the technology industry is doing really bad, your portfolio is going to get completely wiped out. So having a diversified portfolio to try and help reduce the chance of having a massive loss is so important. And for example, there are so many different industries you can buy stocks from, such as the financial industry, the healthcare industry, the utilities industry. But just a little bonus, the best way you can diversify your portfolio without having to do too much research into what stocks you have to buy is by putting your money in an index fund. Because basically index funds, say like the S&P 500, own 500 of the best performing companies, meaning you can't get much more diversified than this. Now, another way to make you a better investor is dollar cost averaging. Because if we've learned anything from the stock market over the years, it is definitely this.
He knows if the stock is going to go up, down, sideways, or in fucking circles.
Now, although this scene seems like a little bit of a joke, it couldn't have summed up the stock market any better, to be honest. Because it doesn't matter how many calculations you do or if you're a professional analyst, nobody knows if the stock market in the future is going to be up or it's going to be down. Now don't get me wrong, I'm not saying don't do any analysis of a company, because performing analysis of a company's financial statements and other analysis is fundamental in picking your stocks to ensure you're successful. But it definitely doesn't mean you're going to be able to predict the price of a stock in the future. Now, because we know we'll never be able to predict the price of a stock in the future, it's best to dollar cost average them when you're investing. This means once you've done your analysis and pick which stocks or index funds to invest in, you then invest the same amount weekly or monthly from your paycheck. Now, why is this so important? Well, let's say you saved up for 6 months or a year. Now you have a massive pile of cash that you decide to invest at the same time. Now, how on earth as an investor would you know whether you're buying in at a high point in the stock price or at a low point in the stock price? Now, what does this mean? If you buy at the high point, there's very likely there's going to be a drop in the stock price at some point, and it's going to take you a lot longer to get back to the point where you first invested. However, if you were to buy the stock at the low point, it's likely you'll see bigger gains in the future. However, that's a 50% chance, and it's definitely not worth it, because I guarantee you'll end up getting it wrong most of the time. So it's probably just better to invest your money with dollar cost averaging. Because if the professional investors in billion-dollar mutual funds can't predict the price of a future stock, it's best to stay humble and not try and predict the price either. Now finally, a little extra tip that doesn't exactly have to do with value investing, but is so important, is not investing all your savings. Now, why is this so important? Well, there's going to be costs that are going to come up in your life that you're going to need savings for to cover. For example, say you want to go and buy a new car, or you have a very expensive medical bill. This would mean you'd actually need some savings to cover those expenses when they come up, because trust me, they will. Because let's say you don't have any savings to cover those sometimes big and random expenses, this would mean you'll have to sell some of those stocks, and depending on how the market is doing, you might lose a very good position in the market, or you'll be selling your stocks for a loss. Therefore, it's so important to make sure you leave some money aside when you're investing, so that you do have those savings to cover those costs when they come up. And if you don't like the idea of just leaving your money in the bank and not really earning any returns, there are ways you can earn a return in the bank with very little risk and still being very easy to get your money out. For example, if you have extra cash in the bank, you can put this amount in a term deposit, and if you ever need to pull the money out, the only repercussions is that you'll lose the interest you could have earned on the term deposit, and there might be a small transaction fee for getting your money out. And with interest rates being very high all around the world right now, it's very likely you could open a term deposit account with very high interest rate returns. Such as the term deposit I currently have open has interest rate returns of over 5%. Now, if you want to open a term deposit account, it's as simple as Googling the term deposit rates at your local bank to see what rates they offer. Now, to just quickly sum up what I think are good qualities to become a good value investor, you need to be an investor, not a speculative buyer. You need to have a diversified portfolio, and you need to invest in dollar cost averaging. And finally, it's probably a very good idea to leave some cash aside in your savings for those emergency expenses that will come up in your life. Anyway, thanks for watching. If you enjoyed the video, please like and comment down below what you'd like to see next time, as it really helps out the algorithm. Till next time, see you later.